Forget the price ticker. Forget the red candles you've been staring at for the last 48 hours, burning a hole in your screen. What you are witnessing right now is not a market correction. It is not a healthy pullback. It is a coordinated assassination attempt on the price of silver, executed in the dead of night while the Western world was distracted by holiday preparations. They waited until you were asleep. They waited until 11:47 p.m. on Tuesday, December 23rd. They waited for the liquidity to dry up, for the skeleton crews to man the bank desks, and for the volume to thin out to almost nothing. And then, they pulled the trigger. This wasn't a trade. It was a raid. In the next minutes, I am going to deconstruct exactly what just happened to your portfolio. I am going to show you the weapons they used. Weapons that have nothing to do with supply and demand and everything to do with survival and control. I'm going to show you how they weaponized the calendar against you. But before we descend into the mechanics of this fraud, understand one thing. This volatility is not a sign that the squeeze has failed. It is the definitive proof that the system is terrified. They have moved from managing the price to defending their existence. If you want to understand the war being waged on your wealth right now, a war fought with algorithms and midnight policy changes, you need to subscribe to this channel. Join us, and let's tear the cover off this operation. You feel it, don't you? That tightening in your chest when you check your phone and see weeks of gains wiped out in minutes. It's not just about the money. It's the injustice. You feel the frustration of knowing that the fundamentals haven't changed. The factories still need metal, the vaults are still draining, the deficits are still expanding, yet the price is collapsing. It feels like you are playing a game where the referee is betting against you. And that is because you are. The modern financial system is not designed to make you rich. It is designed to extract value from your labor, dilute your savings through inflation, and transfer what's left to the balance sheets of institutions that produce nothing but risk. When you buy silver, you are not just buying a commodity. You are opting out of their Ponzi scheme. You are betting against their ability to maintain the illusion of fiat currency. And right now, the illusion is breaking. What happened on Christmas Eve was not risk management. It was the system operator looking at the board, realizing the wrong side was winning, and deciding to flip the table. They call it rule changes. I call it theft. This is the manual of how they steal from you without ever breaking the law. They don't use a gun. They use a policy update at 3 a.m. They use a margin notice posted quietly on a website. They use the silence of a suspended market. They want you to feel isolated. They want you to think you are wrong. But you are not wrong. You are just early, and you are standing in the way of a tank. Let's walk through the crime scene. The sequence of events is the evidence of intent. It started with a rally that looked too honest. Silver wasn't just going up, it was escaping. Resistance levels that had humiliated bulls for decades were shattering like glass. Momentum was stacking on itself. The price stopped negotiating and started fleeing. It was behaving like a free market. And for the banking cartel that manages these prices to protect the dollar, a free market is a lethal threat. A free market in silver exposes the worthlessness of paper money. So, at 11:47 p.m., the CME Group issued an emergency notice. This is the nuclear option. They hiked margin requirements for silver futures by 75%. Let that number sink in. 75%. Imagine you bought a house, signed the mortgage, and moved in. Then, 2 days later, the bank calls you at midnight and says, "The rules have changed. We need another $100,000 in cash by tomorrow morning, or we are taking the house and selling it at auction." That is exactly what happened to thousands of traders overnight. On Tuesday, it cost $15,000 to hold a contract. At 12:01 a.m. Wednesday, it cost $26,250. That is an instant capital call of $11,250 per contract. Now, think about the timing. This is crucial. It's Christmas Eve. The banks are closed. The wire transfers are frozen. Corporate treasurers are on vacation. Even if you had the money, you couldn't move it. This was not an accident. This was a liquidity trap. They designed a problem that had no solution. They knew traders couldn't meet the call. They knew the only option would be forced liquidation. And that is the beauty of the weaponized margin call. The exchange doesn't have to sell your position. They make you sell it. They force you to dump your contracts into a liquid holiday market. When you are forced to sell, you accept any price. You hit the bid, no matter how low it is. This drives the price down further, which triggers the next wave of margin calls for the traders who were barely hanging on. It is a self-reinforcing death spiral, a cascade of forced selling, and they triggered it on purpose. Does this sound familiar? It should. We have seen this movie before. Flashback to 1980. The Hunt brothers are cornering the silver market. The price is vertical. The banks are on the ropes. They are facing insolvency. Do they accept the loss? Do they admit they were on the wrong side of the trade? No. They changed the rules. They implemented Silver Rule 7. They declared that traders could only sell contracts, not buy them. Liquidation only. The price collapsed violently. The banks were saved. The Hunts were destroyed. Now look at 2011. Silver hits $49. The momentum is unstoppable. What happens? The CME raises margins 5 times in 9 days, an 84% total increase. The rally strangled. The price crashed to $33. And now, Christmas 2025. The exact same playbook. The exact same weapon. But there is a new layer to the 2025 attack that makes it even more insidious. High-frequency algorithmic warfare. While the margin calls are forcing humans to sell, the machines are hunting. The bank algorithms know exactly where your stop losses are hidden. They can see the order book. In the thin volume of Christmas Eve, it takes very little capital to push the price around. The algos initiated a stop run. They aggressively sold paper contracts to push the price down just enough to trigger the automatic sell orders sitting below the support lines. Once those stops are triggered, the computer executes a sell order. The price drops further. The next set of stops is hit. This is why the chart looks like a waterfall. It is not human sentiment. It is a chain reaction of mathematical triggers, engineered to wipe out the leverage in the system before the real move begins. They are clearing the board. They are shaking the tree to see which weak hands fall out. They are counting on your ignorance. They are betting that you will look at the crashing price and think, "Oh, the bubble burst." They are betting that you won't see the mechanic behind the curtain pulling the lever. But this time, the battlefield is different. And this is where their plan begins to rot. In 2011, the rally was driven by paper speculation. It was hedge funds using 20-to-1 leverage. When the margin requirement went up, they died. They had no choice. In 2025, the buyers are not speculators. They are industrial giants. And this creates the green paradox that the elites cannot solve. Think about the agenda of the global establishment. They want a green transition. They want net zero. They want electric vehicles, solar panels, and smart grids. Guess what all of that requires? Silver. Lots of it. Solar panels are not made of Bitcoin. EVs don't run on credit default swaps. They run on physical silver paste. This puts the system in a civil war against itself. On one hand, the banking cartel needs to suppress the silver price to protect the dollar and the bond market. On the other hand, the industrial complex needs silver to remain affordable and available to build the green future they promised. If silver goes to $200, the green transition becomes too expensive. If silver stays at $30, the mines go bankrupt and supply vanishes. They are trapped. Do you think Samsung cares about the CME margin requirement? Do you think Tesla is trading futures contracts on margin? No. They are buying physical bars. They are taking delivery. When the price drops on the paper market because of these dirty tricks, the industrial buyers don't panic. They celebrate. They view it as a discount. The grandmother in New Jersey holding 500 ounces in her safe doesn't get a margin call. The solar panel manufacturer in Shanghai doesn't care about the COMEX rulebook. They need the metal. And this is the nightmare for the banks. They can crash the paper price, but they cannot print silver. They can manipulate the digital ticker, but they cannot force metal to materialize in the vaults. Let's go deeper into the psychological warfare they are using right now. This is the gaslighting phase of the operation. While the margin calls are forcing liquidations, you are seeing something else on the charts: massive sell walls. Enormous blocks of silver contracts appearing just above the price, signaling overwhelming supply. It looks terrifying. It looks like everyone is rushing for the exit. It is a lie. This is called spoofing. These are fake orders placed by algorithms to intimidate you. They flash a 5 million ounce sell order to scare buyers away, and then cancel it milliseconds before it executes. No metal changes hands. Only the illusion of supply is created. They are painting the tape. They are designing a chart that looks like a crash to convince you to sell your real assets for their fake paper. It is theater. And in this theater, the ending was written before the curtain went up. They want you to believe that the demand has vanished. They want you to believe that the fundamentals have changed overnight. But ask yourself, did the silver deficit disappear at 11:47 p.m. on Tuesday? Did the mines suddenly double their production? Did the solar industry decide to stop making panels? No. The only thing that changed is the cost of admission to the casino. This is the Christmas trap. They engineered a crash for the holidays. They want you to spend your Christmas dinner arguing with your family, worrying about your portfolio, feeling like a fool. They want to break your spirit so you capitulate on Friday morning. They need you to sell so they can cover their short positions at $68 instead of $80. It is a transfer of wealth from the impatient to the strategic, from the fearful to the informed. But unlike previous years, the trap is already failing. Look at the recovery. They smashed the price to $70 in the overnight session, and what happened? Buyers stepped in immediately. The price ripped back to $72.10. They tried to kill it, and it wouldn't die. This resilience is the signal. It tells us that there is a floor beneath this market that is not made of paper promises. It is made of physical necessity. You need to understand the difference between a market failing and a market being stopped. A market fails when buyers disappear. A market is stopped when the price becomes incompatible with the survival of the system. When you see the words trading suspended or hear about emergency limits, you are not watching protection. You are watching a confession. The CFTC announced emergency position limits at 1:15 a.m. No single entity can hold more than 5,000 contracts. Then, at 2:30 a.m., 3 hours before Asian markets opened, the COMEX issued a statement warning of potential trading halts. Why? Why announce the threat of a halt before the market even opens? Fear. They are trying to psychologically break you. They are trying to create a limit-down scenario where fear replaces analysis. They are terrified of the gamma squeeze. The banks sold 47,000 contracts at the $67.50 strike price. Those options are deep in the money. Their computers, the algorithms that run the hedging desks, are mathematically forced to buy futures to hedge those losses. They are trapped in a loop. If the price goes up, they have to buy. If they buy, the price goes up. The margin hike was their desperate attempt to break that loop, to force enough selling to push the price back down below the strike price before expiry. They are fighting math with fraud, and math usually wins in the end. So what is the endgame here? How does this battle conclude? We are approaching the moment of truth. The Shanghai Signal. Watch the spread between the New York paper price and the Shanghai physical price. If the COMEX crashes to $68 on Wednesday, but Shanghai opens on Thursday trading at $82, the game is over. That spread, that $14 gap, is the smoking gun. It proves that the paper price is irrelevant. It proves that the rest of the world has stopped listening to the corrupt signals coming out of New York. If that happens, arbitrageurs will drain the COMEX vaults. They will buy the cheap paper silver, stand for delivery, and sell it in Shanghai for a massive profit. The vaults will empty at record speed. The regulators can control the price on the screen, but they cannot control the flow of physical metal across the ocean. We are witnessing the end of an era where price could be managed indefinitely through leverage, confidence, and compliance. That era died at 11:47 p.m. on December 23rd. When they changed the rules to stop a winning trade, they sent a message to every sovereign wealth fund, every central bank, and every industrial consumer in the world. The COMEX is not a market. It is a trap. Capital goes where it is treated best. And right now, capital is realizing that Western financial markets are hostile territory. They cheated the market. They halted trading. They changed the rules. And in doing so, they admitted the one thing they never wanted you to see. They are losing. Do not let them shake you out. This is psychological warfare, plain and simple. They are bombing your morale because they cannot defeat your position. If you own physical silver, you have already won. You hold the asset that they are desperate to hide. You hold the truth in a world of lies. If you are in the paper market, understand the risks. You are playing in a casino that hates you. But understand that the volatility you are seeing is the death rattle of a broken system. They have fired their biggest weapon. The margin nuke has been detonated, and the price is still standing. The Christmas trap was their last stand, and it is failing. Share this video. Don't just like it. Send it to every trader, every investor, every person you know who is trying to build wealth in this rigged system. They need to know that they are not crazy. They need to know that the game is fixed, but the house is on fire. The rules have changed, but the outcome is inevitable. Physical reality always wins. Welcome to the war.